It is December the 24th, a day usually reserved for quiet and reflection, a pause before the year turns. But while much of the world has slowed down, the metals markets have quietly sent a signal. This week, both gold and silver reached all-time highs. Welcome to Money and Power. If you're new here, this channel isn't about predictions or hype. It's about understanding how money, markets, and power actually interact beneath the surface. If that kind of context is useful to you, do consider subscribing. Because while the evening news may be focused on holiday spending or seasonal market cheer, the signal coming from the metals markets is far more somber. What we're seeing is not excitement, it's not optimism. It's a quiet shift away from the current monetary consensus. And it's happening at a moment when most people have stopped looking. Today isn't really about prices, it's about what those prices are responding to and what they may be signaling as we move towards the new year. There are a few quiet signals embedded in these record highs that matter far more than the headlines, and I want to walk through them calmly. Gold briefly moved above $4,500 an ounce. Silver pushed beyond $73 an ounce. Put simply, those are extraordinary numbers. Over the course of this year alone, gold is up roughly 70%, its strongest annual performance since the late 1970s. Silver has done even more, rising by over 140%. Those figures matter, but not for the reasons most people think. For many, numbers like that immediately suggest speculation or excess. They invite comparisons with bubbles, manias, or moments of irrational enthusiasm. But on this channel, we don't focus on just the numbers themselves. We focus on why that number can exist and why it can hold. Markets don't move in isolation, they move as part of a system. And the first signal here is not excitement, it's restraint. If there were a speculative surge, it would be loud. It would come with urgency, emotion, and dramatic narratives. That isn't what we're seeing. What we're seeing instead is quiet positioning, steady buying, very little public commentary. Prices move higher, pause, and then remain close to their highs. That behavior matters because it tells you this isn't about momentum or short-term enthusiasm. It's about reweighting. Capital isn't chasing a story, it's adjusting to conditions. Now, there's a historical ghost worth addressing here because many people will already be thinking it. The last time gold and silver delivered annual gains of this magnitude was the late 1970s. That period is remembered as a frenzy, speculation, the Hunt brothers, excess. And that memory still shapes how people interpret metals today. But this moment is fundamentally different. Back then, the move was driven by leverage, concentrated bets, and speculative excess at the edges of the system. What we're seeing now isn't leverage, it's structure. It's central banks increasing allocations, it's institutions adjusting balance sheets, and it's long-term capital responding to systemic pressure. There is no rush to exit, no sense of celebration, no frenzy. And that contrast matters, because it tells you this is not a bubble repeating history. It's a refoundation responding to present realities. Which brings us to the second signal. At these levels, gold and silver stop behaving like trades and start behaving like reference points. The market isn't asking, how high can this go next week? It's asking something more fundamental. What does money represent when confidence in the system is being reassessed? When gold rises sharply during an obvious crisis, people notice. But when it rises quietly during periods of apparent calm, it's usually because institutions are responding to pressures that haven't yet become visible in the headlines. And those pressures are very real. Global debt levels remain historically high. Refinancing requirements are building into the middle of this decade. And interest costs no longer sit comfortably within government budgets. In the United States alone, around $10 trillion of Treasury debt is expected to mature and require refinancing over the 2026 window. That's not a political problem, it's a mathematical one. And gold and silver aren't rising because they are getting better. They're rising because the cost of maintaining a debt-based system is finally becoming visible. This is why the record itself isn't really the point. The behavior around it is. And that brings us to the third signal. At record highs, neither gold nor silver is behaving like a bubble. There's no vertical acceleration, no blow-off behavior, no sense of euphoria. Instead, prices rise, consolidate, and hold. That tells you the buyers aren't hoping for a quick exit. They're not chasing headlines or social media narratives. They're positioning for durability. In simple terms, this isn't about making money quickly. It's about preserving value over time. And that distinction matters. Because when preservation becomes more important than growth, it tells you something fundamental about confidence in the system itself. Now, especially on a day like today, it's important to be clear. This isn't a call to action, it isn't a prediction, and it isn't a reason to panic. Record prices don't mean something breaks tomorrow. But they do mean that assumptions people have lived with for years are being quietly questioned. Assumptions about currency stability, assumptions about perpetual refinancing, and assumptions that risk can always be deferred. Gold and silver do not create those questions, they reflect them. That's why the distinction between signal and noise matters so much. The noise is the price. The signal is why that price can hold without excitement. As the year comes to a close, many people will be thinking in terms of forecasts, resolutions, and fresh starts. But the more important exercise is understanding what has already shifted. Markets don't wait for calendar years. They adjust when pressure demands it. And the fact that these record highs have arrived quietly, without celebration or drama, tells us this isn't a moment of triumph. It's a moment of transition. A transition away from certainty and towards resilience. As we move further into the second half of this decade, with tighter liquidity and growing refinancing pressure, those transitions will matter far more than any single price print. So if there's one thing to take away from today's discussion, it's this. Don't focus on how high gold or silver has gone. Focus on why holding real value is becoming more important than chasing returns. That shift doesn't make headlines, but it changes behavior. And behavior over time reshapes the system itself. On a day meant for reflection, that feels like the right place to pause. Not excitement, not fear, just understanding. If you found this analysis useful, please give the video a like. It helps the channel more than you might realize. And if you haven't already, do consider subscribing to Money and Power and turning on notifications so you don't miss future discussions as these themes continue to unfold. If you'd like to go deeper, you may also want to watch the recent video on why gold and silver have been rising for the wrong reasons, or the upcoming discussion on the refinancing pressures building into 2026. Both linked directly to what we've talked about today. Thank you for spending part of your Christmas Eve here, and I look forward to seeing you in our next video.